Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, the insurance sector in India opened the new year with a wide range of largely customer-friendly changes by the IRDA on the 1st of Jan 2014. Now, the IRDA has now set certain benchmarks in terms of minimum payout, regulation of commissions to agents, the equalization of non-linked and market-linked plans. The new regulations has also resulted in the discontinuation of many old plans offered by insurers and the introduction of innovative new ones. Now, to see how you can benefit from these changes, we have with us Yashish Daya, CEO of Policy Bazaar, also its founder. Yashish, welcome to the show. A lot of changes by the IRDA. I mean, can you begin with some of the changes in the non-market linked plans?
Sure. So if you look at it on a holistic basis, what's happened is your sum assured, which is a life cover in the life insurance policies, has been increased. So the minimum life cover required now for any insurance policy for you to qualify for the tax benefit is 10 times your annual premium if one is less than 45, and if one is over 45, then 7 times the annual premium. The second problem was a lot of policies used to get cancelled very quickly and people used to surrender very quickly. So now the minimum tenure is 5 years. Linked to that were certain surrender costs. The surrender costs still stay high, but they are much better than earlier. So if a policy is discontinued between second year and third year, one would get 30% of the amount that the one has paid will come back to the person. If it is discontinued between the third year or between the fourth year to the seventh year, it will be about 50% of what one has paid. And only if you continue beyond 7 years is there a minimum guarantee of 90% of what you have paid will definitely come back to you, and whatever growth comes in will also come in. So it makes no sense now to buy the policy for a period less than 7 years because you definitely lose out, right? Now, along with this has come a new, what you call a new actuarial table, a new mortality table. Mortality table is a table basis which the cost of life insurance is calculated. And there were a lot of questions which we have also faced in the past, that why are people at different rates in terms of life insurance policies. So now the new table, so every company, including the LIC, was using the 1996 table. Now the 2004 tables have come out, which have reduced the cost of life insurance further. And this is primarily because people are living longer. The last piece was, there was a service tax element, which the LIC was not charging consumers, while every other company was charging consumers. Now LIC also has to charge that service tax element because everybody is, now the fact is LIC was paying this to the government, but it was deducting it as charges. Now it's no longer deducting it as charges. They are explicitly being charged to the consumer upfront. So I think these are the broad changes that have happened in the market. Mostly a mechanism to make the product better for the consumer. Is it there in terms of being a really good product yet? I would say there are question marks around that. It could have been better, but it's certainly better than what was earlier. It's a step in the right direction. It's a step in the right direction.
I mean, these provisions are going to certainly help, the consumers.
Absolutely, the consumers benefit because first of all, it's become more transparent. The consumer knows what one's getting into, and it's very simple. If anybody is selling a plan for less than 7 years, they are almost certainly misinforming the consumer, is the minimum I can say. Because below 7 years, you would only get 50% of the money back.
What about the market-linked plans? How has that changed with the new regulations?
So with the new regulations, the market-linked plan also, the same sum assured concept has come in. So you have to have a life cover at least 10 times the annual premium. And I'm talking about regular pay plans. So if you take a single pay plan, that same number is 1.25 times. So if you take a 10 lakh rupee investment in a single premium, then one has to have a 12.5 lakh rupee sum assured to qualify for the tax benefits. However, so that is the one change that has happened. In terms of a tenure of policy, the ULIPs or the unit linked plans had changed in 2010 and they had become 5-year plans. So they are still 5-year plans. In terms of surrender charges,
so those are the benefits that the consumer gets, right?
Actually, there's a loophole out there which the consumer should not use, which is if you actually take a ULIP and you cancel it, because of the guaranteed return that one gets, one can actually make a very good investment in the short term. But that is not how insurance should have been bought. This is just a loophole. And a lot of insurance policies are being sold through that loophole right now, but that's something that's not good.
Right. And so, again, to sum it up, what are the real benefits? Because that's what we're looking at. What are the real benefits that a consumer can immediately take? I mean, I'm not talking about the tax part of it. We'll come to that a little later. But just as far as the policies are concerned.
As far as the policies are concerned, basically the surrender charges have come down. They are very open. So beyond 7 years, remember earlier after 7 years also, you could end up getting 30% of what you have paid back. Now, after 7 years, you will definitely get at least 90% of what you have paid back. So as long as you can hold out for 7 years, the chances of an exorbitant loss are not there. In terms of surrenders of ULIPs, it's become a lot simpler. So you can surrender and you won't lose out as much. So those are the benefits that have gone in. The life insurance component has been bumped up a bit, which is a good move, because otherwise you're buying the product for life insurance. You're not buying it for investment loan. If you're buying it for the life insurance cover, then you get the life insurance cover. I think those are the two benefits that come along. In terms of agent costs and distribution costs, those were really addressed in the ULIP regulation of 2010. The 2013 does not do too much practically to how much the agent gets.
So what if a consumer wants to take advantage of the tax benefits that one gets out of investing in insurance policies, given that the new regulations by IRDA have come in? So what is the best way to take advantage of those?
See, there are two ways to do that. One is, if one has a 15 to 20 year view, there are certain traditional products which offer about 6% plus returns. Very few of them, very, very few. One can point those out, but there are very few of them. Now, if one is getting a 6% return, when you do the tax break element and you add the 30% back, it almost becomes like an 8.5% return. Now, fixed deposits do not go beyond 10 years. So it can work somewhat like a fixed deposit, giving you an 8.5% return with a guaranteed payout with no risk. And this can work for about a 15 to 20 year time frame, not for very short time frames. On the other hand, the long period for a pension planning, the low cost ULIPs are an excellent bet. They are, in my view, the best product today, primarily because you have got a tax exemption when one invests, and when one gets the money, also there's a tax exemption. And what that means is all the money, all the growth, you would get it all tax free. So whether you invest in a mutual fund or whether you invest in a FD, the tax benefits are not as strong as they are for investing in a low-cost ULIP. And more importantly, the low-cost ULIPs, some of them are today operating at a total in-place cost of about 1%. Now remember, equity-linked mutual funds operate at about between 1.5 to 2.25%. So this is actually a lot cheaper than even the mutual fund. So it does start to make some sense in terms of, at least if you're taking a long-term view, low-cost ULIPs make a lot of sense.
So what about from a company perspective? Has this benefited the company? And also, a huge number of new products have come out as a result. I'm told nearly 500 of those. Yes. Many old ones have been discontinued. People may have an apprehension, I bought such and such plan 3 years back, it's now been discontinued. That doesn't really affect the consumer, does it?
So see, plans have changed, and insurance companies are going through a lot of change, and clearly we were onto a wrong track in the sense, and we still continue to be to a large extent in terms of how we are selling most of the traditional insurance products, etc. They're not consumer friendly. So opaqueness, complexity hides the consumer disbenefits, and the consumer gets confused, and then that's what leads to a lot of lapsation and all those things. So to some extent, those challenges have been aggravated for the insurance companies because the products have to be created up to a certain standard, and the consumer knows a little more about those products. So the industry is going through challenging times. I can't see where this is headed, but the industry is going through some challenging times. I think right now it's in a tough spot.
I think that's one of the things that you've pointed out, that that opaqueness doesn't really help the industry, nor does it help the consumer, because there's a certain apprehension that comes in that I haven't got the benefit that I really wanted to get out of a policy that I bought.
See, short term opaqueness helps the industry because short term the profits come from the opaqueness. Transparency does not help the industry in the short run, but in the long run, if you want to have an industry 20 years from now and a growing, healthy insurance industry, then transparency is a must. Opaqueness will give you short-term profits, but in the long run, it's going to come and hurt.
We've got Beena Mathur from Kanpur, and she asks, are there any insurance policies for arthritis, for costly injections without, the person doesn't want to obviously pay, but does that fall into the ambit of health insurance?
Unfortunately, arthritis can be covered by insurance. However, one has to get it covered before they know they've got arthritis. That's the basic rule of insurance. One cannot take out a policy knowing there is a certain cost. Then it becomes a certain cost and you need just financial planning around it. Now, as far as arthritis is concerned, once it has happened, one can declare it as a pre-existing disease. And there are plans which would from 2 years to 4 years start covering the costs of arthritis. However, they would mostly require at least a 24-hour hospitalization and associated costs happening along with that. For certain procedures and OPD, there are some plans, but they're fairly limited. So those are mostly tax-saving plans in the sense you get a 4,000 to 10,000 rupees spend on an OPD perspective, and there, of course, the injection, expensive injection, if they are within the 4,000 to 10,000 rupees, will get covered. But that is essentially you paying out of your own money from a tax-saving perspective because you get a tax break on the health insurance one takes, and so essentially you get 15,000 rupees as your tax-free allowance. So you can, if you put that money, you won't pay taxes on 15,000 rupees of income, and you can use the same 15,000 rupees to pay OPD charges. Some policies are structured like that. There is a policy from ICICI Lombard, there's a policy from Bajaj, and you could certainly look at those policies. However, knowing that there is a risk and without hospitalization, nothing is going to cover it otherwise.
And I guess that gets us back to the advice that one is always given, that, get into health insurance as early as possible.
As early as possible, definitely before 40, 45, because after 40, 45, these, as I'm 41, as you start getting to that age, people do start getting a bit tired. The body has its kind of issues. And I think about 40, 45, if one's not taken health insurance, one is, basically living on some kind of a time bomb where one disease comes and after that health insurance becomes unavailable.
Right. We've got Abhish from Guwahati, and he writes, I have a term plan from LIC for 25 lakh rupees for 11,925 premium annually for the next 35 years. Should I keep it or should I shift? What do you think?
I think you're paying 11,000 rupees. It's not a very large sum of money. I'm assuming for the cover you've got a salary of about 3 lakh rupees. So if you're comfortable with this, stay with this. The cost that you can get, if I'm assuming the individual is a healthy individual, is about 5,800 rupees. So you could get something for about half the price. No particular issue with that policy. Nothing great about the policy you have, nothing bad about the policy. They're pretty much the same policies. So you can get it at half price. But if this insurance is a lot about comfort also. It's about peace of mind. If you get peace of mind with this policy, there's no particular need to change just because you save 5,000 rupees. Stay with it. So it's up to you. It's your call.
We've got Inder from Bhopal who writes to us and says, due to some unforeseeable circumstances, I haven't been able to pay my premium for my life cover for about a year. I had paid premiums for 5 years before that. The policy has lapsed now. Is there any way that I can revive the policy?
Absolutely. So there is clearly a way by which the policy can be reinstated. There is a simple form which needs to be filled and submitted to the insurance company. And with that, your policy will get reinstated. You will have to pay the premiums that you have missed. Maybe with interest if the insurance company demands that. However, in case it is a very large cover, so one has not mentioned how large the cover is. In case it's a very large cover, there may be a medical required again, because the insurance company might get suspicious that, if you did not pay for 1 year, why do you want to restart it? Now, obviously, there must be a genuine reason. And hence, going through a medical should not really be an issue if required. That will most probably, if it's less than a 5 lakh rupee cover, nobody's interested. So if your annual premium is less than 50,000 rupees, typically you should not have an issue. But if it is more than that, then you may have an issue.
Right. We've got Deep, who's written to us from Kolkata. He says, I have a Honda Brio bought under the finance scheme from Sundaram Finance. Is it mandatory for cars bought on loan to buy comprehensive insurance or third-party insurance? Will third-party insurance suffice?
So see, let's get this very clear. Third-party insurance is mandatory by law. Whether you have a loan or don't have a loan, you must have a third-party insurance, because what the third-party insurance protects is in case your car goes and damages somebody else's property, somebody else walking on the street, anything. So all of that is covered by third-party insurance. However, third-party insurance will in no way help your car loan company, because the third party does not cover your car. And hence, while you have a car loan, I am pretty if I was giving you a car loan, I would make sure that you had an insurance policy for your car, because suppose tomorrow your car has an accident and you don't feel like getting it repaired. The person who's given you the loan, they suddenly have nothing to hold on to, because they were holding on to the car essentially, and the car is gone. So what's the value? So clearly, if somebody is providing a car loan, they will insist that you have a comprehensive insurance policy. And even you should try to have a comprehensive insurance policy, because the damage, if it does happen, see, accidents happen all the time. You may be a very safe driver, but it can be somebody else's mistake. And in India, we have this knock for knock effect. So you have to make no mistake, your car can be parked and somebody can come and damage it, and you will have to pay for your car. So, that's the sad part of it. So get a comprehensive cover. Even thefts, etc., are covered by comprehensive covers.
All right, we've got Sandhya with us. Sandhya, go ahead with your question.
Sir, I wanted to know, with the Malaysian Airlines disaster, what kind of precautions can a good travel plan give me? Also suggest some good plans.
Right, so Sandhya is worried about, the after effects of the Malaysian Airlines crash, and asks what precautions should one take, and also what a good travel insurance plan should comprise of.
A good travel insurance plan comprises of basically a health insurance plan. So in case you're traveling abroad, it covers for health. It should ideally cover pre-existing diseases, because just because you have a pre-existing disease, if you have an emergency, you don't know when the emergency happens. So at least pre-existing emergencies must be covered. It will automatically cover basic things like loss of baggage, loss of passport, etc., and putting you back onto scheme, putting you back on track with your plan. Those should definitely be covered. I think hijacking and all these things are high up in the mind now. So from a comfort perspective, yes, if it has a cover for that will be helpful. But it is not very valuable to have a cover from that. Like I'm talking statistically and financially, it's not a very valuable cover to have. So principally focus on the health cover, and try to make sure that, specifically if you have pre-existing diseases, that pre-existing diseases are covered in your health insurance policy, because emergencies can happen anytime, and the cost of insurance abroad is very expensive.
Right. Thanks, Yashish. Now, that's all the time that we have on this episode of Policy Bazaar. But do write to us at ask.policybazaar.com or tweet us at policybazaar_in. And we'll see you next time. Goodbye.